So the Treasury situation just seems to be getting worse every single day. Now, this is the most pressing issue that determines if we get a collapse or not. By now, everyone knows the truth. The US will forever issue bonds to fuel their spending. But the big question is, will the supply overwhelm the demand? And how fast until we get to the day of default? Now, you would think there would be some responsibility in the Treasury Department, but we are getting a lot of deflection and obscure justification here.
We didn't get here in the past 100 days. It's the Biden administration and the spending that we have seen over the past 4 years. We inherited 6.7% deficit to GDP, the highest when we weren't in a recession, not in a war, and we are determined to bring the spending down and grow the economy.
Now, what Bessent says makes sense, right? Yes, the deficit hit 6.7% in the previous administration. It's also true that Biden goosed up the economy over the last 4 years as well. But Bessent's job is to reduce the debt and bring bond yields down. But all the policies being made today points to a breakdown of trust. No one believes the US can get their fiscal house in order. As it stands, the deficit is horrific. In the first 6 months of the financial year, the government borrowed and spent $1.3 trillion they didn't have. April had a surplus of nearly $260 billion. But don't jump for joy just yet. There's a budget surplus every April because that's when tax collections come in, and it's a fraction of the total deficits. So we have 5 months left to go, and the market realizes that a time bomb is going to go off. Trump is fighting a trade war, and his tax bill, which just cleared the House, is going to jack spending to the high heavens. As a result, confidence in Treasury bonds are cratering even worse than ever before. And if you bought US paper when yields were 4% because you thought a recession would push them to 3 or even 2%, well, you just got played. We might be entering a new paradigm where the US economy slows down or even enters a recession while rates continue to stay high. And here's how severe things have gotten. The 10-year yield has hit a crazy 4.6%, higher than the levels immediately after April the 2nd. The 30-year yield has melted up to nearly 5.1%, and the 2-year yield has hit an incredible 4%. But notice how the yields on the longer end, the 10 and the 30-year, have risen much faster than the 2-year. Overall confidence is being lost, but investors are puking more when it comes to long-term US paper. And here's Dalio telling us in simple English why the US economy is screwed. Trust is evaporating faster than ever before.
There is a breakdown of the supply-demand picture for the bond market. You see a certain type of market action. You see long rates rising relative to short rates. You see the currency go down. You see gold go up because there's a movement out of that bond market because there's a supply and demand imbalance. When that happens, that raises interest rates, and it puts the Federal Reserve and other central banks in a bind.
So there is an oversupply problem relative to demand, but there's simply no U-turn left because of US trade policy. Now Trump is desperate to paper over the cracks. His plan is to give US citizens money to spend through the tax cuts. But at the exact same time, the tariffs are going to take away the extra spending power. And on the surface, it looks like everything is netted off. However, the burden of this is being thrown on top of the US debt. And because of that, all US assets beyond just treasuries are looking very, very unattractive. Now, the dollar itself is still collapsing and US stocks are underperforming the rest of the world. And it's simple to understand why. Higher rates means a higher cost of capital. And when borrowing costs fly up, the US economy will materially slow down. So all risk assets are repricing down, and that also hammers the dollar further as well. This is why US equities are still selling down, and it probably won't end until yields start to go much lower. For those that still buy US assets, a higher yield will shift money away from stocks to bonds as well. So something has to give. This situation can't continue because it will break the system. But the tariff war is putting a floor under interest rates, and there's no way to bring it down using monetary policy. Powell is not going to budge and cut rates. We also haven't felt the full brunt of the tariffs yet. 30% on China is still happening, and 10% for the rest of the world, so prices aren't going to come down if ever. Now, what's really telling is the US Treasury auctions going bad. The 20-year bond sale just crashed and burned. It pushed the value to new lows and triggered yields to spike even higher. In addition to that, the ultra-long bond, the 30-year yield has risen well past 5%, heading back to the 2023 peak. There are big concerns that include long-term inflation and dollar devaluation. Now, when long-term yields shoot up, everything from mortgage rates to auto loans to corporate bonds and insurance liabilities, they get rocked. What the world needs now is clarity from the White House, but even today, we are getting nothing at all.
Where do we stand on trade deals? The last we heard that we were getting close to 20 deals, and we were promised that these deals would be announced soon, but why no announced deals yet?
Well, first, there's a lot going on in the world, as you know, and there's been a lot of focus over the last couple of days in the White House. But I was in the Oval yesterday with Howard Lutnick and Jameson Greer going over some of the next steps, and I'm highly confident that you'll see a handful of new deals over the next 2 weeks. And Lutnick and the president are still finalizing the details, but they're so close that I feel like we're very close to having some more announcements, and there's probably a handful of near-term announcements.
The world doesn't want to see a handful of deals. We were all promised 90 deals in 90 days. I want my burger with fries and nuggets on the side. But Trump is only going to serve us an apple pie. And that's why bond yields are flying through the roof. And no, the UK deal doesn't really count as a win. It's important we look at a terrible debt auction to figure out what went wrong. In the previous auctions, global investors were rejecting US bonds. This time it's even worse. Domestic buyers for the 20-year bond came in extremely cold, only 14.1% of bidders versus the average of 17.1%. When domestic buyers stop buying US bonds compared to foreign money, it's a clear sign of the big crisis ahead. American buyers aren't bothered about currency exchange rates. Demand is collapsing basically because of inflation worries. In other words, the 20-year bond that pays over 5% yield every single year is no longer attractive. Investors, they believe inflation will easily outpace the yield. So why are US buyers so bearish on long-term bonds? It's because Trump just refuses to stop spending. His big and beautiful bill is going to ramp up deficit spending like no tomorrow. There's really nothing complex about this. The US government is simply spending too much. In 2024, the budget deficit stood at $1.8 trillion. The CBO expects the deficit to more than double in the next 10 years to $3.8 trillion annually. By then, it might hit anywhere from 8 to 10% of GDP for the fiscal deficit, and that puts the US on an unsustainable borrowing path. Either taxes were to fly higher, which we all know probably won't happen, or Bessent's successor would have to borrow even more money. Now, a big misconception is that the US can print their way out of the crisis, and they did it before in 2008 and 2020, and that didn't collapse the system. But we were still in a globalized world. The demand for dollars was still very strong. And now that Trump wants to break global trade, the extra dollars printed will circulate more within the US itself, and it will drive inflation to unthinkable levels. So that route is most definitely out of the question. Here's another problem with increasing bond issuance. It destroys the capacity for private investment. By 2035, private investment in the US will have 13.6% less investment versus being fiscally responsible. Government bonds always compete with corporate bonds for money, and there's a finite amount of capital in the world, and the more debt Bessent issues, the more he will crowd out the supply of bonds. By 2045, we are looking at 17.6% of growth being lost, and that's why investors, they're getting the yips when it comes to US assets. How much more productive can US companies get versus other markets? And many countries out there like China, they have lower borrowing costs, so industries are not competing tooth and nail with government borrowing. Is it any wonder why major finance players are sounding the alarm bells? JPM knows what's up, and Jamie Dimon himself, he's in panic mode. The US is facing huge risks from geopolitics, deficits, and price pressures, and that's coming from his interview in Shanghai, which is quite ironic. He believes the Fed is also right to hold interest rates because inflation is still a crisis, but that's also admitting that the economy will likely fall into stagflation as well. It's a world of sluggish growth where inflation stays high, and let's not forget rising unemployment as well. And that doesn't mean that US stocks will collapse to zero, it means it could bounce up and down for months or even years on end. And if you think about it, we have seen this playbook before, haven't we? Trump bashed Biden about providing stimulus when there was no emergency. Then again, does Trump's trade war really qualify as a national emergency as well? Since when does a trade deficit qualify as a national emergency? There's also a ton of mixed information coming out from the White House. Apparently, consumers, we are all hallucinating about higher prices.
Everything in the world's got 10%. You go to the store now, are you feeling the pain? No. Why not? Because there is no pain. Because what happens is the sellers, the producers, the sellers, and the currencies change, and the price effectively mostly goes away. But seriously, for the month of May, every product in the world's got 10% on it right now, with no exceptions, no exclusions. That we have 25% on cars and that are coming in from out. Do any of you feel anything?
Consumers will feel that.
Well, I said it's already on. This is on since April. So when it's not that the tariff is coming, it's on. Have any of you felt any of it? Seriously.
So everything in the world is 10% more expensive, but yet we feel no pain. And this is bargain level, basement standard, bottom shelf logic. It's a tragedy. He said that the currency changed. Well, he's 100% right about that. The US dollar today is even weaker than ever before. And the last time I checked, a collapsing dollar means more expensive imports into the United States. This is the level of thinking today, which means the White House will press on with this crazy tariff war. They will also explain away their tax bill, especially the inflationary impacts. And here's how insane a tax bill will be, especially to the deficits. The US economy will be facing a type of emergency stimulus for the next 10 years. The deficit would rise by over $500 billion every single year. And if we translate this into Treasury speak, $500 billion more of US bonds will be issued annually. And how is this going to bring yields down? We could be in a world of higher inflation and higher yields where the dollar might just fail to recover. As it stands, unless Bessent stops issuing bonds, only a recession can bring borrowing costs down. And this is where things get really dicey. What will be the end game going forward? Everything points to real inflation soaring higher. The US economy needs to cut something from their budget, but what can they truly cut? There's no way to cut social security and other entitlements, not when prices at Walmart are going to fly up. How about defense? We can forget about it. The US is still in an arms race against China. So the only option left is to cut net interest payments. In the first 7 months of the fiscal year, the net interest stood at nearly $580 billion, $65 billion more than last year. Solving the problem is mighty easy. Just inflate the debt away by dropping yields, either strong-arm the Federal Reserve to crash rates or print money to buy up the Treasury supply. And this is perhaps the only area left the US government can cut. Maybe there is another way, but I personally can't see any other exit routes. Even as we speak, the 30-year has flown up to 5.15% yield. This is the highest level since October 2023 and July 2007. Can Trump or Bessent really afford to sit back and twiddle their thumbs? The higher this goes, the bigger the debt crisis and the closer we get into an economic implosion. But the big question still remains. What can they actually do here? The 90-day pause is already in effect. The US and China, they have a truce of sorts. Maybe the only way left is to raise the white flag and call off the entire trade war. We are now at emergency levels. But let me know what you think. Will investors continue to shun US bonds? And what options does Bessent and friends really have left? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.